This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 17, 2026, and this is the New York session. Now, let's get into it. The US dollar is locking onto a vice grip. We are seeing aggressive unwinds in the British pound and Australian dollar as institutional flows flee risk, while the fear and greed index plunges to 14 out of 100. But amidst the panic, gold is clinging to $3,990, and the VIX remains stubbornly quiet. Let's dissect the mechanics of this squeeze. Turning our eyes to the calendar, the only scheduled event on our verified list for Friday, July 17, is monthly OPEX. While this derivative expiration often drives intraday volume volatility, today's price action is being dictated entirely by the post-release data digestion rather than the expiry itself. Apex, how does the current positioning interact with this end-of-month window?
Monthly OPEX usually encourages a flattening of gamma, but with the fear and greed index at 14, we aren't seeing standard hedging flows. Instead, we are seeing raw directional deleveraging. The liquidity vacuum created by OPEX settlement is exacerbating the unwind in pound and RC, turning what should be a quiet session into a liquidity trap for anyone holding risk assets overnight.
Here is the snapshot as of 9:29 Eastern Time. The US dollar is broadly stronger, led by gains against the pound, which is down 0.1% at $1.3464. The Australian dollar is lagging harder, off 0.27% at 0.698145. Meanwhile, the safe haven complex is split. Gold sits at 3,990.36, up 0.11%, while silver follows at 55.3645. In equities, the mood is captured by the VIX at 15.67, down 0.83, even as stock market sentiment crashes. Let's get into the noise. Breaking the top wires, we have three critical developments shaping this session. First, U.S. housing starts for June came in at 1.427 million, smashing the estimate of 1.31 million. Second, U.S. June import prices rose 0.3% versus negative 0.7% expected. And third, the S&P 500 stays under pressure as the peak inflation narrative collides with the U.S.-Iran crisis. Pulse, start us off with the macro implications of that housing data. The housing data is the anchor dragging down any hope for early rate cuts. 1.427 million starts against a 1.31 million forecast is a massive miss on the downside for doves. It reinforces the higher for longer narrative immediately. Combined with import prices ticking up to positive 0.3% from negative 0.7%, the Fed has a clear mandate to hold rates at 3.63%. There is no room for error in their guidance right now. So the data is telling the central bank to stand pat. What does that do to the currency maps?
It forces capital into the dollar. Look at the yield curve. The 10-year minus 2-year spread is flattened at plus 0.41 basis points, yet the 2-year yield is sitting at 4.13%. That steepness in the front end, driven by sticky imports and hot housing, makes the dollar irresistible. It explains why we see the dollar index testing highs while everything else bleeds.
CIPHER, looking at the flows, is this a broad-based rotation or something more concentrated?
It's a targeted liquidation. The COT data doesn't lie. We are seeing a catastrophic unwind in pound-leveraged funds, negative 18,447 contracts week over week. That isn't a gentle profit-taking, that is forced deleveraging. Simultaneously, RC-leveraged funds have dumped 2,094 contracts. The smart money isn't just reducing risk, they are exiting specific high-beta exposures. Meanwhile, asset managers have added 22,196 net long contracts to the dollar index. The institutional conviction is overwhelmingly one way.
And SPECTER, with all this unwinding happening, the VIX is sitting at 15.67. Does the market realize how fragile this setup is?
VIX is screaming silence. We have the fear and greed index at 14. That is extreme terminal fear. but the VIX is barely moving, hovering in a tight range between 14.96 and 17.56. That is a dangerous divergence. Options markets are completely underpricing the risk of a volatility explosion. If a single piece of data misses tonight, or if the US-Iran headlines escalate, that compressed VIX will snap back violently. We are walking through a minefield with earplugs in.
Let's break down the individual instruments. Starting with the flagship pair, Cable, it's trading at $1.3464, down 0.10%. Grid, walk me through the technical structure here.
Technically, Cable has broken down to 1.3464, but the real story is the lack of bids. We saw a fracture in the support structure earlier in the week, and price action is now drifting lower with minimal resistance. The psychological level of 1.35 is gone. Without that cushion, we are looking at extended ranges toward 1.3400. The chart shows exhaustion. Every small rally gets sold instantly because the underlying flow, as CIPHER noted, is dominated by that negative 18,000 contract dump.
And that negative figure is the key. Grid might see a flat line, but I'm seeing a cliff. Those leveraged funds haven't stopped selling. Until we see the weekly delta turn positive, any technical support at 1.35 is just a place for buyers to get trapped. The pressure is unilateral right now.
Pulse, does the macro environment offer any relief for the pound?
None. The UK economy is facing the same global headwinds, but with a weaker domestic data backdrop. The pound is caught in the crossfire of a surging dollar and a risk-off equity market. Unless the Bank of England signals a radical shift, which they haven't, we are stuck in a structural downtrend for sterling. The higher-for-longer US narrative leaves no oxygen for pound recovery.
Moving to the Pacific, Aussie dollar is at 0.698145, down 0.27%. Grid, what are we seeing on the Aussie?
Aussie dollar is currently at 0.698145, which is dangerously close to the 5-day low of 0.69127. We are essentially skirting the edge of a breakdown. If price closes below 0.69127, we expose the next support at 0.68500. The volume profile is thin, which means a little bit of sell pressure can drag this much further. It looks like a slide, not a bounce.
Confirming the slide, the RC leveraged funds are down 2,094 contracts. They are running for the hills. The commodity correlation is broken right now because the dollar strength is overriding oil and iron ore prices. There is no institutional support here.
SPECTER, with the Aussie at these lows, is a snapback trade viable?
Absolutely not. You are trying to catch a falling knife when the VIX is compressed. If you buy the 0.69 level expecting a mean reversion, you are betting against the entire flow engine. The risk of a further drop to 0.685 is asymmetrical. Stick to the sidelines.
Let's shift to the yen complex. Dollar-yen is at 162.3780, effectively flat on the day but holding cycle highs. Grid, how is the yen handling this?
Dollar-yen is consolidating near 162.378, just shy of the 5-day high of 162.5485. We are seeing a consolidation flag. The uptrend is intact, but the momentum is stalling. We need to see if price can reclaim 162.5485 to confirm continuation, or if we'll see a rejection that sends us back toward 161.500. Right now, it's a standoff.
The standoff is artificial. The Bank of Japan held rates unchanged, as reported in the headlines, but that hasn't stopped the yen from weakening. The U.S. yield differential is too wide. The 2-year note at 4.13% versus the Bank of Japan's near-zero stance creates a gravitational pull that the yen cannot resist. The consolidation is just the market catching its breath before potentially pushing higher.
What about the inverse? Euro-dollar. It's at 1.1439, down 0.06%. Grid, is the euro holding?
Euro-dollar is at 1.1439. Hovering just above the critical 5-day low of 1.13776. This is a binary level. If it breaks 1.13776, the next support is 1.13783 from July 14. The structure is fragile. We are seeing repeated tests of 1.13776, and each test is getting closer to the wire. It's a slow bleed, but the bleeding is real.
and the funding costs are working against the euro. The net long positions in euro leveraged funds are dwindling as the dollar index accumulates. There is no fuel left for a rally. The flow data confirms the technical weakness.
Finally, let's look at the safe haven. Gold is at 3,990.36, up 0.11%. Grid, why is gold not rallying harder given the fear index at 14?
That is the puzzle. Gold is at 3,990.36, sitting just above the 5-day low of 3,969.26. Normally, at a fear and greed reading of 14, gold should be surging. Here it is being suppressed. The chart shows a tight range between 3,969.26 and 3,995. It's a compression coil. The fact that it isn't breaking out suggests the dollar bid is acting as a lid. Every time gold tries to move up, the dollar sells it off.
Because the real yield is the enemy. The 2-year yield is at 4.13%. Gold pays no yield. When you can get over 4% on a risk-free U.S. instrument, gold becomes less attractive. The higher-for-longer narrative is actively capping gold's upside despite the geopolitical risks mentioned in the headlines regarding Iran. The math is fighting the emotion.
And that's where the risk lies. If the VIX suddenly expands, if that divergence between the 14 fear and greed score and the 15.67 VIX resolves, gold could see a violent spike as traders scramble for safety. Or, conversely, if the dollar breaks, gold could gap up. Either way, the quiet at $3,990 is deceptive. Watch the 3,969.26 level like a hawk. A break there changes the game.
Apex tie this all together. We have dollar strength, pound/Aussie liquidation, and a gold complex that refuses to break out. What is the operational takeaway?
The operative theme is data-driven liquidity vacuum. Pulse highlighted how the housing and import data larked in the higher-for-longer narrative, creating a fundamental barrier for pound and euro. CIPHER quantified the result: a massive, structural unwind in pound and Aussie leveraged funds that is mechanically suppressing price action. Grid mapped the technical fallout: euro-dollar flirting with 1.13776 and Aussie dollar scaling along 0.69127. But SPECTER raised the critical warning: the VIX at 15.67 is dangerously detached from the 14-point fear and greed. The market is underpriced for a shark. The thesis is not to chase the dollar rally into Friday's close, but to respect the fragility. The pound and Aussie are being carved up by institutional flows, and any attempt to buy the dip in euro or gold is fighting both the macro headwinds and the technical breakdowns identified by Grid. Safety is in the cash or waiting for Monday.
To sum up the session, the US dollar is commanding the market, fueled by hotter-than-expected housing and import data. The British pound and Australian dollar are undergoing a forced liquidation, with technical supports at 1.34 for sterling and 0.69 for the Aussie under severe strain. Meanwhile, gold and the euro are stuck in compression zones, suppressed by rising yields and a subdued VIX. Tomorrow, keep an eye on whether the euro-dollar can hold 1.13776 and watch for any volatility spike in the VIX that could shatter the current calm. This has been the ShadowQuant Forex edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.